John D. Rockefeller, a name synonymous with immense wealth and unparalleled business acumen, was not merely the richest man of his era. He was the architect of modern business strategies that remain profoundly relevant for traders and investors today. His approaches to the market were revolutionary, often controversial, yet unfailingly effective, laying the groundwork for how industries consolidate, optimize, and dominate. Born into modest circumstances, Rockefeller navigated the chaotic economic landscape of late 19th century America, a period marked by the oil rush, fierce and often cutthroat competition, and a notable absence of clear regulatory frameworks. It was amidst this volatile environment that he meticulously constructed Standard Oil, an empire that redefined the scale and scope of corporate power, transforming a fragmented industry into a highly efficient, integrated behemoth. This video will delve into 6 pivotal strategies that enabled Rockefeller to achieve market supremacy, illustrating their practical application and enduring lessons for contemporary investment and trading practices. The first strategy that underpinned Rockefeller's unparalleled success was an uncompromising dedication to efficiency and an obsessive optimization of costs. He understood that in a nascent and competitive industry, the ability to offer the lowest prices was a decisive advantage, enabling him to outmaneuver rivals and capture market share relentlessly. Rockefeller believed that every penny saved was a penny earned, and he instilled this ethos throughout every single facet of his sprawling business operations, from the smallest manufacturing detail to the largest logistical challenges. His relentless pursuit of cost reduction was legendary, bordering on the fanatical as he meticulously scrutinized every process and every expenditure, always seeking ways to do things better, faster, and cheaper than anyone else in the industry. This philosophy was not merely about saving money. It was about creating an insurmountable competitive moat. Historical accounts abound with examples of Rockefeller's almost pathological attention to detail in cost-cutting. One famous anecdote recounts his directive to use precisely 39 drops of solder instead of 40 to seal the kerosene cans, a seemingly insignificant change that, when multiplied across millions of cans annually, translated into savings of thousands of dollars each year. This micro-level optimization was mirrored in his macro-level strategic decisions, such as acquiring vast tracts of forests, establishing his own lumber mills, and building barrel factories. By controlling the entire barrel production process, he drastically reduced the cost of each barrel from an industry average of $2.50 to a mere $0.96, giving Standard Oil a massive advantage in packaging and distribution. He even hired his own plumbers to lay pipelines, cutting labor and material costs in half compared to relying on external contractors, demonstrating his desire for complete control over every variable. Perhaps one of the most brilliant examples of his efficiency drive was the innovative approach to byproduct utilization. In an era when most oil refiners simply discarded the waste products of kerosene production, Rockefeller saw untapped value. He invested heavily in research and development to find commercial uses for what others considered refuse, transforming gasoline, initially a worthless byproduct, lubricating oils, paraffin wax, and petroleum jelly into profitable commodities. This not only eliminated disposal costs, but also created entirely new revenue streams, turning waste into wealth and further solidifying Standard Oil's financial superiority. This foresight allowed Standard Oil to operate with incredibly lean margins on its primary product, kerosene, while still generating substantial overall profits from these secondary ventures, making it incredibly difficult for competitors to match their pricing. For modern traders and investors, Rockefeller's unwavering focus on efficiency offers invaluable lessons. Firstly, it underscores the critical importance of minimizing commissions and transactional costs in investing. Even seemingly small fees, when compounded over long periods, can significantly erode long-term profitability, making platforms with lower fees or more efficient trading strategies highly advantageous. Secondly, it highlights the need for optimizing tax liabilities, utilizing tax-advantaged accounts and structures to preserve capital and maximize after-tax returns, a strategy that directly impacts the net wealth accumulation. Thirdly, investors should meticulously analyze hidden costs associated with their investments, paying close attention to all aspects of the investment process, from the cost of research and data subscriptions to the expense of custodial services, or even the implicit costs of liquidity, ensuring that every expense is justified and minimized. This holistic view of cost management, inspired by Rockefeller, can significantly enhance an investor's net gains. The second core strategy employed by Rockefeller was aggressive vertical integration and an unrelenting pursuit of control over the entire supply chain. He understood that true market dominance required more than just producing a good product. It demanded command over every stage of its journey from raw material to the final consumer. This comprehensive control provided Standard Oil with unprecedented oversight of costs, quality, and pricing, forging an almost unassailable competitive advantage that few could hope to replicate. By owning every link in the chain, Rockefeller eliminated reliance on external parties, reducing vulnerabilities and maximizing profit margins at every step. This strategic vision allowed him to dictate terms and set standards across the industry, rather than merely react to market forces. Standard Oil's vertical integration was breathtaking in its scope. The company owned oil wells for extraction, state-of-the-art refineries for processing, an extensive network of pipelines for efficient transportation, its own fleet of railway tank cars, oil tankers for maritime distribution, and a vast network of distribution centers and sales agents to reach end consumers. This complete ownership allowed Rockefeller to optimize each segment, ensuring seamless operations and absolute cost control. The pipelines in particular became a critical choke point for the industry. By controlling the most efficient means of transporting crude oil to refineries and refined products to markets, Standard Oil could effectively dictate terms to competitors who relied on less efficient or more expensive transportation methods, thereby squeezing their margins and forcing them into disadvantageous positions. For contemporary traders and investors, the principle of vertical integration translates into several actionable insights. Firstly, it emphasizes the value of deep understanding of an asset or a company's operations. Investing in companies that control a significant portion of their value chain often signals a more resilient business model with greater pricing power and reduced external dependencies. Similarly, for commodity traders, a thorough understanding of the entire supply chain, from extraction to processing and distribution, can reveal critical insights into market dynamics and potential arbitrage opportunities. Secondly, the concept of owning the choke point remains highly relevant. Investors should seek out and invest in companies that control critical resources, essential technologies, or crucial infrastructure within their respective industries, as these entities often enjoy sustainable competitive advantages and significant pricing power. Thirdly, considering diversification within a single industry can be a powerful strategy. By investing in different segments of the same industry, e.g., exploration, refining, and distribution in energy, or hardware, software, and services in tech, investors can mitigate risks associated with any single segment while still capitalizing on overall industry growth. Rockefeller's third strategy was the aggressive and strategic consolidation through mergers and acquisitions, M&A, of his competitors. He did not shy away from using ruthless tactics, often initiating devastating price wars to financially cripple rival oil refiners, leaving them with little choice but to sell their businesses to Standard Oil at significantly undervalued prices. This relentless consolidation allowed Standard Oil to rapidly achieve a near-monopoly position in the market, eliminating competition and giving it unparalleled control over pricing and supply. His approach was not merely about acquiring assets. It was about systematically eliminating threats and absorbing market share piece by piece until dominance was absolute. This strategy demonstrated a profound understanding of market power and how to leverage it. The infamous Cleveland Massacre of 1872 serves as a stark illustration of this strategy. In a mere 6 weeks, Rockefeller orchestrated the acquisition of 22 out of 26 competing oil refineries in Cleveland effectively wiping out his local competition and solidifying Standard Oil's grip on the refining hub. His approach was often to offer owners of acquired companies shares in Standard Oil rather than just cash, allowing them to participate in the future success of his rapidly expanding empire. This shrewd tactic not only conserved capital but also aligned the interests of former rivals with his own, turning them into partners rather than adversaries. Furthermore, Rockefeller pioneered the use of trusts, a legal arrangement that allowed him to combine numerous companies under a single management, further centralizing control and amplifying his influence across the entire industry, setting a precedent for corporate structures that would dominate for decades. For modern traders and investors, understanding the dynamics of M&A is crucial. Analyzing how market consolidation impacts company valuations and stock prices can uncover significant investment opportunities or risks. Investors should pay close attention to industries undergoing consolidation, as dominant players often see their valuations increase as competition decreases and market power grows. The adage, "buy when there's blood in the streets," directly echoes Rockefeller's opportunistic approach to acquisitions during market downturns or crises. Investing in assets when prices are depressed and competitors are weak can yield substantial returns when the market recovers, mirroring Rockefeller's strategy of acquiring distressed assets at bargain prices. Furthermore, identifying and investing in companies that already possess a strong market position or demonstrate a clear potential to achieve it through strategic consolidation can be a cornerstone of a robust investment portfolio. These dominant players often have the resources and strategic foresight to continue expanding their influence, providing stable long-term growth. The fourth strategy, a testament to Rockefeller's genius, was his masterful art of negotiation and his adept use of leverage. He skillfully exploited Standard Oil's sheer volume and market power to forge highly advantageous deals, particularly with the burgeoning railroad companies. These agreements secured significant discounts known as rebates on oil transportation, a privilege unavailable to smaller competitors, further driving down Standard Oil's operating costs and making it virtually impossible for rivals to compete on price. Rockefeller understood that in business, power came from scale, and he was relentless in converting that scale into tangible financial advantages through superior negotiation. His ability to extract concessions from powerful entities demonstrated a profound understanding of economic leverage. These clandestine agreements with major railroads were a cornerstone of Standard Oil's dominance. In exchange for guaranteeing stable, massive volumes of freight, Rockefeller secured not only preferential rates but often also received drawbacks or kickbacks from the freight charges paid by his competitors. This meant that the railroads were essentially subsidizing Standard Oil's operations, even when transporting rival products, creating an incredibly unfair and powerful competitive advantage. These hidden benefits allowed Standard Oil to consistently undercut competitors who were forced to pay significantly higher transportation costs, making their businesses unsustainable in the long run. This complex web of agreements highlighted Rockefeller's unparalleled ability to manipulate the system to his advantage. For contemporary traders and investors, the lessons from Rockefeller's negotiation prowess are profound. Firstly, it underscores the importance of understanding a company's market power in its dealings with suppliers and customers. Companies with strong negotiating leverage often enjoy better terms, higher margins, and greater resilience to economic fluctuations. This moat around their business can be a strong indicator of long-term investment potential. Secondly, investors should actively seek out invisible advantages that companies might possess. This involves analyzing whether a company benefits from unique agreements, proprietary relationships, or hidden structural advantages that provide a sustainable competitive edge not immediately apparent on financial statements. These subtle benefits can be crucial differentiators in a crowded market. Thirdly, Rockefeller himself highlighted the paramount importance of soft skills in business. He famously stated, "The ability to deal with people is as purchasable a commodity as sugar or coffee, and I will pay more for that ability than for any other under the sun." This quote reminds investors that strong leadership, effective communication, and shrewd negotiation are intangible assets that can drive significant value and should be considered when evaluating management teams. The fifth strategy that defined Rockefeller's enduring success was his remarkable long-term vision and an extraordinary capacity for adaptability in the face of change. He was not merely a reactive participant in the market. He was a proactive shaper of its future. His success was deeply rooted in a strategic foresight that allowed him to anticipate shifts, adapt swiftly to evolving conditions, and consistently innovate his processes, always staying several steps ahead of his rivals. This forward-thinking mindset distinguished him from contemporaries who were often caught flat-footed by market transformations. He possessed an uncanny ability to see beyond the immediate horizon, envisioning the landscape of tomorrow. One of Rockefeller's earliest and most impactful insights was his recognition of the immense potential in oil refining, rather than solely in oil extraction. While many rushed to drill for crude oil, Rockefeller understood that the real profits lay in processing and distributing the refined product, which offered more stable margins and greater control. His ability to diversify assets and strategically reorganize Standard Oil following the landmark antitrust legislation of 1911 exemplified his adaptability. Rather than crumbling, he managed to not only preserve but significantly multiply his capital by restructuring his holdings into numerous independent companies, many of which became industry giants themselves. His early and substantial investment in pipelines, when the conventional wisdom still favored railroads for long-distance transport, was a counterintuitive move that proved extraordinarily profitable. This decision demonstrated his willingness to challenge established norms and invest in future-proof infrastructure, illustrating his quote, "I always tried to turn every disaster into an opportunity." For modern traders and investors, Rockefeller's long-term vision and adaptability offer profound guidance. Firstly, it underscores the importance of investing in the future. This means focusing on companies that actively invest in research and development, embrace new technologies, and are poised to disrupt or redefine their industries rather than clinging to outdated models. Secondly, it champions counterintuitive thinking. Successful investors are often willing to go against the crowd, seeking opportunities where others see only risk or overlook potential, much like buying when there's blood in the streets. This requires independent thought and conviction. Thirdly, it highlights the virtues of resilience and flexibility in investment strategies. Developing portfolios that are robust enough to withstand market shocks and agile enough to adapt to new economic, technological, or regulatory conditions is paramount for sustained long-term success. This proactive approach to anticipating and navigating change is a direct legacy of Rockefeller's strategic genius. Speaking of anticipating market shifts and understanding the intricate dance of financial history, have you ever wondered how past titans navigated financial crises, or what truly shaped the legendary figures of Wall Street? Just as Rockefeller meticulously studied every aspect of his market, a deep dive into financial history offers invaluable context for today's investment decisions. For those who seek to understand the cycles of boom and bust, the rise and fall of empires, and the enduring lessons from the financial architects who came before us, I highly recommend exploring Wall Street Memoirs. This exceptional channel serves as a treasure trove of knowledge, offering captivating narratives on historical events, profound financial crises, and the remarkable individuals who left an indelible mark on Wall Street. It's an essential resource for anyone looking to enrich their understanding of market dynamics beyond the daily headlines, providing the historical perspective necessary to cultivate a truly long-term vision, much like Rockefeller's. Don't miss out on this incredible opportunity to learn from the past, to better navigate the future. You can find the link to Wall Street Memoirs in the description below. The sixth and final strategy that cemented Rockefeller's legacy was his astute approach to strategic diversification and the disciplined reinvestment of profits. Having achieved unparalleled dominance in the oil industry, Rockefeller did not rest on his laurels. He systematically reinvested the colossal profits generated by Standard Oil into a diverse array of other industries, including railroads, real estate, banking, and steel manufacturing. This calculated diversification was not just about spreading risk. It was about building a robust, multifaceted financial empire designed to preserve and exponentially grow wealth for generations to come, exemplified by the creation of sophisticated trusts. He understood that enduring wealth was built on multiple pillars, not just one. His investment portfolio extended far beyond oil, encompassing significant stakes in major railway companies, numerous banks, vast tracts of prime real estate, most notably the iconic Rockefeller Center in New York City, and pivotal interests in steel mills. These strategic investments were carefully chosen to complement and reinforce his existing wealth, creating a network of assets that provided both stability and further growth opportunities. Crucially, Rockefeller was a pioneer in establishing elaborate family trusts, which became the bedrock of the Rockefeller strategy for intergenerational wealth preservation. These trusts were ingeniously structured to ensure tax efficiency, protect assets from future liabilities, and provide a stable financial foundation for his descendants, embodying a truly long-term approach to wealth management. Even his extensive philanthropic endeavors, though driven by a genuine desire to give back, were also part of his broader strategy for managing and utilizing his immense fortune, shaping his public image, and securing his legacy. For modern traders and investors, Rockefeller's approach to diversification and reinvestment offers critical takeaways. Firstly, it powerfully underscores the paramount importance of portfolio diversification. Spreading investments across various asset classes, stocks, bonds, real estate, commodities, and different sectors is fundamental to mitigating risks and achieving more stable, consistent returns over time, preventing over-reliance on any single market segment. Secondly, the strategy highlights the transformative power of reinvesting profits. Consistently plowing back dividends and capital gains into further investments, rather than merely consuming them, activates the magic of compound interest, allowing wealth to grow exponentially over extended periods, a cornerstone of long-term financial success. Thirdly, Rockefeller's example emphasizes the value of long-term wealth planning. Considering advanced tools for wealth preservation and transfer, such as trusts, foundations, and estate planning, as pioneered by the Rockefeller family, can be instrumental in securing financial well-being for future generations and navigating complex tax landscapes. This holistic approach ensures that wealth is not just accumulated but also protected and perpetuated. In conclusion, the 6 strategies employed by John D. Rockefeller, uncompromising efficiency, vertical integration, strategic consolidation, mastery of negotiation, long-term vision and adaptability, and strategic diversification with profit reinvestment, were the foundational pillars of his extraordinary success. These principles allowed him to transform a fragmented and chaotic industry into a streamlined, dominant force, accumulating a fortune that remains legendary. While many of Rockefeller's methods were undeniably controversial, and indeed a significant number of his aggressive tactics would be deemed illegal under modern antitrust laws, the underlying principles he championed remain remarkably powerful. They offer profound, actionable insights for contemporary traders and investors who aspire to achieve market dominance, build resilient portfolios, and create sustainable generational wealth in today's complex financial landscape. The legacy of Rockefeller is not merely in his wealth, but in the enduring lessons he provides regarding strategic thinking, relentless execution, and adaptive business leadership. His story is a testament to the power of foresight, discipline, and an unyielding commitment to excellence. We encourage you to analyze and adapt these timeless strategies, not as a blueprint for illegal monopolistic practices, but as a framework for building your own path to success, remembering the critical importance of discipline, foresight, and a constant pursuit of improvement in your investment and trading endeavors. The principles of efficiency, control, strategic growth, leverage, adaptability, and diversification are universal truths in the pursuit of financial mastery, waiting to be applied. As we reflect on the strategies that built an empire and the enduring principles that govern financial success, it's clear that understanding the past is often the key to unlocking future opportunities. For those truly committed to mastering the intricacies of financial markets and learning from the triumphs and tribulations of bygone eras, there is an unparalleled resource that offers an insider's perspective on the very foundations of American finance. I am speaking of 50 Years in Wall Street, the monumental two-volume illustrated memoirs by Henry Clews. This isn't just a book. It's a journey through half a century of Wall Street history, from the tumultuous panic of 1857 right through to the opulence of the Gilded Age. Clews, a prominent figure himself, provides unique accounts of financial titans, unveils the mechanics of market manipulations that shaped fortunes, and offers insider views on pivotal events that echo even today. It's an indispensable work for anyone seeking to grasp the historical context of market behavior and the timeless strategies that separate the legends from the forgotten. To delve into this rich narrative and gain insights that could profoundly influence your own investment philosophy, secure your copy of 50 Years in Wall Street today. The link is in the description.